Okay, great. One of the most popular planning techniques companies use is budgeting. Our task for this lesson is to explain what a budget is and how companies use it. So, a budget contains the goal set for the next year or the next couple of years and includes a detailed plan of how to achieve these goals. Planning identifies potential opportunities and bottlenecks in advance and helps management make important decisions when leading the company towards its goals. Almost every company uses a budget in its daily operations. The gelato shop on the next corner does it, and so does Walmart. Budgeting is an essential part of corporate finance and a key tool for any firm that wants to stay in business. Once a budget is created, executives and the firm's financial analysts have a clear idea of where the company's sales must be throughout the year. They have a guideline of how the company should perform in any month. They can also track whether their costs correspond to those planned in the budget. So, this tool provides a significant level of accountability and can be a reality check by business unit managers. To understand the reasoning behind budget preparation, we need to think about the following questions. What is the main goal of a business? What is the most important thing it must do? The one thing without which it would cease to exist? Well, yes, every business must make money, and if it doesn't, it won't be able to pay salaries to its employees or any other costs that arise and will go bankrupt. So we can agree that a company's main goal is the generation of cash. Therefore, its budget must contain a detailed projection of the cash the business will generate during the year. We have to focus on the amount of money that will go in and out. This is precisely what the cash flow statement shows us. We will need to calculate a profit and loss and a balance sheet, because profit does not always equal cash for most businesses, because not all payments will be made in the period under consideration. There are always clients who ask to pay their bills a few months later, and so do companies when they need to pay their suppliers. This generates a difference between profit and cash. You could have sold goods to clients and registered sales in the profit and loss statement, but if the clients don't send the payment, you won't see a difference in the cash flow statement. We've not generated cash. When preparing a budget, we'll have to monitor all three statements: the P&L, the balance sheet, and the cash flow. Typically, companies prepare their budgets by using the expertise of people working in their marketing and finance divisions. Marketing executives can provide their sales forecast, which serves as the basis of the entire budget, and then financiers model the development of the rest of the expenses and investments. Once a budget has been prepared, then comes the hard part, trying to achieve the set goals. Sales teams push forward to achieve the top line, while the finance department controls expenditure. The whole company is working towards reaching the planned results. But almost always, unforeseen events occur, and our initial plans must be changed. For example, the sales division can be negatively surprised if one of the company's larger clients moves their business elsewhere, like when Apple stopped buying microchips from Intel and chose a different supplier. Did this impact Intel's budget? Absolutely. Did the world end there? No, it didn't. Intel took a hit on its expected sales numbers, but could also win other major accounts, such as Huawei. And its expected sales figures for the year changed, but only slightly. These things happen for every business in any year. Clients come and go. Sometimes the firm wins more than it loses. Other times it does not. That's normal. What I'm trying to say is the budget could be a static model not adjusted throughout the year. However, most companies use a flexible planning model, which allows them to review their results on a monthly, quarterly, or bi-yearly basis, and submit forecasts that correspond to the current situation and are updated with the latest estimates for the period. This method allows companies to correct their budgets due to newly emerged circumstances and to plan how to deal with what has happened as they go forward. A firm's top management should not use the budget as a whipping stick. It should aim to sell the numbers to the rest of the employees. Everybody will have to work together to achieve these numbers, and for that to happen, employees must believe in the budget and sort of own these projections. The right way to achieve that is to include up-to-date and realistic information in the latest budget forecasts.